Okay, our last part for this chapter goes into looking at accounting for estimated liabilities, which includes warranties, bonuses. It also actually looks at benefits and vacation time too. So when we think about estimated liabilities, it's a known obligation, but it's an uncertain amount, but we can estimate reasonably what it's going to be. Some of the examples are going to be employee benefits like pensions, health care, vacation pay, and then we also could have warranties that are offered by a seller. So we'll look at each of those different kind of benefits and see how that would be created as an estimated liability. So the first one is health and pension benefits. So a lot of companies provide employee benefits that go beyond that salary and wages. An employer is typically going to pay all or part of medical, dental, life, and disability insurance. But a lot of times we see now that there are some kind of contribution that they're going to have the employee buy into, just so that you have a stake in it. For those who offer pension plans, which it's not as many now, a lot of them have their separate retirement where you invest your own 401k. But if you have a pension plan, that's an agreement for the employer to provide benefits or payments after retirement. If you typically, depending on how long you stay with a company, and there's different requirements, like for the state, for example, you can get medical after you retire, but you have to have been here for 15 years and be 55, and then they would pay 75% of it. Or if you hit that 20-year mark, they pay 100% of it. Now, when I say 100%, 100% of their portion. You still have your own portion that you paid as an employee, and you continue to pay that into retirement. But it's much better than having to go get private insurance out there in the market. So an example they show here, it says, assume an employer agrees to pay an amount for medical insurance equal to $8,000, and they contribute an additional 10% of the employee's gross salary of $120 to a retirement program. So it's an expense to the employer. And that's one of the things I think we don't always think about. When you're accepting a full-time position that comes with benefits, a lot of companies are going to give you a statement at the end of the year or close to maybe the beginning of the next year to tell you what your total salary was if you include all the payments they made for you also. It's actually pretty interesting to see because there's a lot more that employers pay that you don't ever think about. So the example they show us here, we had medical insurance that we're paying for them, and we have retirement that we're paying 10%. 10% of that $120,000 is $12,000. So it's an employee benefit expense of a total of $20,000, and then we're crediting those payables that we'll pay when it's actually time to pay it. The next part goes into vacation benefits. So a lot of employers are going to pay vacation benefits or like paid absences, paid time off, whatever you want to call it. They're giving you time away from your job, but they're paying you your hourly rate or your salary during that time. So they give an illustration that shows vacation benefits here. So if we had 2 weeks of paid vacation and they earned $1,600 each week, that means it's an expense to the employer of $3,200. So that means they're going to set it up as a payable, and then when that employee takes that vacation, they would actually debit it from the payable and credit the cash. So when the employee actually takes the vacation. So here they didn't take all of it, they just took a portion of it, and that's typical. All right, the next part goes into bonus plans. So if your company offers bonuses to their employees, the bonuses typically can be based off of net income. So we'll use that as an example here. So if they had a $10,000 bonus that's being paid to employees, but it's shared by all of them. So we're not saying that each employee is getting $10,000. We're saying that employees as a whole are getting $10,000. So whether this is a good bonus or not, it depends on how many employees, right? So in this example, we're debiting employee bonus expense and we're crediting bonus payable that will pay out when it's actually payday or the day for the bonus to be paid. All right, the next part goes into something that's a little different. So this is warranty liabilities. We haven't seen this before. So a warranty is when the seller has an obligation to replace or correct a product or service that didn't do what it was supposed to do. So it didn't perform as it was expected within a certain period of time. So you might have, like on a vehicle, you might have a 5-year, 100,000 mile full warranty. But after that, it's on you. So here, that's what they're showing us, that they have a warranty, and for the company, it's an expense that we would have to record when we have that sale, because we want the revenue and the expense of that warranty to be reported at the same time. But what we would do is we estimate what that liability is going to be, and we're going to be setting it up as an expense and then crediting that liability that we're going to pay when they actually use that liability. Now again, remember, it's an estimate. We don't know exactly how much it's going to be because we don't know what products are going to have problems. We hope that none of them do. And if they didn't, then that's great. But we're going to report it as a liability, even though, the future amounts are uncertain. We don't know what they're going to be. We're using an estimated amount. And, as we have experience, we might have better estimates that we can use. But in the beginning, it could be simply just a guess. When we look at the journal entry for it, so the example they give here, it says December 1st, 2019, a dealer sells a car for $16,000 with a maximum 1 year or 12,000 mile warranty covering parts. Past experience from that dealer shows that they have 4% on average of warranty expenses from the selling price. So we would take $16,000 times 4%. That's what we're going to estimate as our warranty expense and the liability that we're going to set up. So the next month, the customer returns the car for repairs, and then we have to replace $200 of parts. We pull it out of that estimated warranty liability, and we would be also pulling it out of inventory. So our parts are coming out of inventory. We're debiting the liability account to clear it out, and we're reducing the inventory that's on hand because we're using it now. All right, the other kind of liabilities that we have to look at are going to be contingent liabilities. So contingent liabilities is a potential obligation, and it depends on some future event that's typically from something in the past. So it could be like a pending lawsuit. That's the most common example. So here we see that a past transaction can lead to a lawsuit. The result of that lawsuit depends on what kind of liability we have, right? Are we found that we're responsible, or are we found that we're not responsible? And we don't know that. It's depends on the likelihood of our guilt, I guess. So there's 3 different possibilities that are identified in the chart. We have we can either record the liability, we can disclose it in the notes, or we can have no disclosure. And that depends on the likelihood. So you see that one area where it says future event is either probable, possible, or remote. So the possibilities, if it's probable or likely, then the amount that's owed can be reasonably estimated. We would record that amount as a liability. So an estimated liability described earlier, such as warranties, vacation pay, income taxes, we know that we're going to have to do that. The future event is reasonably possible. So if that's the case, we're going to disclose it in the notes about a contingent liability. So we're going to put it in the notes to the financial statements, and we're going to let them know that it's possible, but we don't have to record a liability. The only time we have to record a liability is if it's probable and we can estimate it. The other one is remote. So if it's an unlikely event, we would not record or disclose the information on that contingent liability. So we look at if it's reasonably possible, it could occur. We disclose the information about the type of contingent liability in the notes. So 2 common examples would be potential legal claims resulting from lawsuits that are made against our company, and then also debt guarantees. And that's when a company guarantees the debt of a sister company or an affiliated company, and they might have to pay for it if that sister company can't. So it's kind of like a cosigner. If someone didn't pay it, then we have to pay it. The other one is going to be other contingencies or uncertainties. So when we're thinking of other contingencies, that could be environmental damages, tax assessments, insurance losses, or if we had the government investigating, we may have a liability from that. And then all companies are going to face uncertainties like natural disasters, new technology. They're not all contingent liabilities because the future events aren't rising from past transactions. So that would mean they would not be disclosed. So you have to follow the guidelines to know whether it will be disclosed or not. All right, our last part is just our ratio for this chapter. It is the times earned ratio, and it takes our income before interest and taxes divided by our interest expense. So this tells us, can we handle paying the interest we have due on the loans or the debt that we have out there? When we look at this, we're going to look for our income before interest and income tax. A lot of times it might be our operating income, but we have to look for the line that we're basically looking for that line that comes before interest expense and income taxes. And that's what we're going to use for that top amount. And then we're going to divide it by the interest expense. And that's going to tell us how capable they are of paying the interest that they have coming due in that year. Here's an example where they show that they calculated it for a company. They took the income before interest and taxes, and they divided that by the interest expense, and it gave them 2.5 times. So when we're looking at that, we have to, we have to look to see if that would be a good number. So we can see that in this example, they had 2.5 times. So that means that Diego has a low to moderate risk because its sales decline sharply before it's unable to pay its interest expenses. If the times interest earned falls below 1.5, a company will likely be at risk of not being able to pay their liability. So we want it to be at 1.5 or higher. If it's over that, we're typically comfortable with that ratio. All right, so that takes us through our lecture for chapter 11. And if you have any questions, please let me know.